I called you the god of economy, aren't you? And you're wearing red. You knew it. You said non-farm payrolls would come 100,000. Well, it came a little above it. But the investors are disappointed. Are they right to be disappointed?
They're right to be disappointed. And even though we're growing, it reflects a slow rate of growth at around 2%, well below the 2.5% trend rate growth in the United States. And here, there's really no way to spin this report into something that's good. There's a couple takeaways that I want to cover. The first thing is average weekly earnings were flat during the month of April, and they slowed in terms of a year-over-year pace to 1.8%, and that's the lowest pace we've seen, I think, since the recoveries began. What that means is even though people are getting hired, their wages are increasing, at least on a year-over-year pace. It's at a slower pace, and it's below the rate of inflation. That means the median income, the median household, is actually falling further behind. While we do want to see continued employment growth, we need to see those wages pick up. The problem is that we have an enormous amount of labor slack here in the United States economy. We're 5.2 million jobs short of what we'd call full employment. And then here's the problem. We've seen this now over the past 8 months. There's a low-wage hiring bias in the economy right now. Hiring is occurring in 4 low-wage subsectors in the economy: retail, temporary hiring, leisure and hospitality, and healthcare and social assistance. Now, that sort of hiring can be sustained, but that's normally the hiring we see at the beginning of a recovery process, not 3 years into a business cycle and over a year into an economic expansion. What we need to see is high-wage jobs in professional and business services and the public sector middle-class jobs. The problem is at the state level. You know, we have 50 states here. At the state level, they're having significant financial problems, and during this particular jobs crisis, the federal government is not making up the difference due to lost tax revenues at the state level. Therefore, they're laying off teachers and firemen and policemen, the sort of bedrock middle-class public service sector jobs that have characterized the labor market in the United States since the end of World War II.
I remember you talked about quality versus quantity, so it brings up to that again.
Quality is job one, and we got to begin adding quality jobs. And this is going to be the difference between a recovery that we traditionally have seen in the United States and one that's frustratingly slow and historically weak.
So the unemployment fell down to 8.1%. We should not even be happy about it. What do you read? How do you read it?
The issue here is that 342,000 people left the workforce. So this is one of those situations where you have economists on and they say, well, down is bad. Well, it is bad. The employment to population ratio fell. Most importantly, the labor force participation rate declined. So we see people leaving the workforce probably because they're frustrated with those low-wage subsector jobs that are available. They're simply not willing to work for wages. Think of it this way. We've lost 2.3 million jobs in the construction sector.
Right.
Those men, and they're largely men, who are used to making $20 to $25 an hour, now have the option of working in a retail environment making $12 an hour. And they're deciding just to sit it out.
I know you mentioned where you want to see the sectors, the industries that are hiring, but companies have been sitting on cash and they haven't been hiring. Do you know specifically which sectors, which companies are hiring?
Well, the companies that are hiring are in the manufacturing sector and in the technology sector. But those jobs require very sophisticated skill sets in science, technology, engineering, mathematics, and information systems. So many of the people who lost jobs during the great downturn in the construction industry, in the public service sector, even in the financial sector, don't quite have the skill sets to fill those jobs. Moreover, the manufacturing renaissance that we're seeing in the United States, and let me tell everybody in Turkey, in 5 years, the United States will be the supreme manufacturing company in the globe. Because of the revolution that's occurring in composite technologies, we're able to make composites that will replace steel, that weigh half the tonnage, that will increase efficiencies and lower transportation costs. This is going to happen. But the thing
in 5 years, and that's why you call it the Renaissance.
The Renaissance. We're undergoing a manufacturing renaissance. But here's the kicker. we're not going to have the economies of scale in terms of the labor market that we had before, because to create those composites requires advanced degrees.
Exactly.
Incredibly sophisticated technology. You can't just graduate high school and go do this.
Do we have it?
In some cases, you need masters and PhDs. We do have it, and if we don't have it, we'll import it.
As always.
As always. No,
Okay.
we'll get there. But the problem is what are we going to do about those individuals who've lost those jobs?
That's the very important question. Another $1 million question that everyone asks.
That's right.
What does this unemployment rate and the non-farm payroll not so good increase mean for the Fed?
Okay, well, this definitely has gotten the Fed's attention, but they're likely going to wait another couple months to see if some of the weather-related payback that I think is at least part of this results in further losses in the job sector. Now, what I think is occurring is that financial shock that we went through in 2008 and 2009 has distorted the data, and it's just going to take a while to work through that distortion. The Fed's been very clear about this. They're uncertain about labor market prospects. Yes, the unemployment rate's falling, but it's not falling in the way that we want to see it. Should we see a slowdown in economic growth, the unemployment rate will pick back up, then we can talk about the Fed coming back and taking more forceful action. But I think we're probably a quarter or maybe two away from that.
Will we see a slowdown? Rubini is very gloomy nowadays. He expects below 2% growth. But looking at the data that came throughout this whole past week, we are a little mixed, right? Look at the service data.
If Nouriel Roubini's breathing, he's gloomy. Okay, so yeah, what happened is that the economy decelerated in the last month, the first quarter. The April data has been generally disappointing. We had a decent manufacturing report last week, but that was pretty much about it. We can see the economy is generally slowing. The key is it just slowing from say 2.2 to 2%, 1.8%, or are we going to move back to 1.5, 1%? If it's in that area of 1 to 1.5, and I don't think that's where we are. I think it's 1.5 to 2.
That's your number?
That's my number right now. That's what looks like is forming. It's very early in the quarter. So we have to wait in the data cycle for the data to come in to catch up. But I think if we're somewhere between 1 and 1.5, then you'll see that unemployment rate begin to tick back up, and the Fed will start talking about taking action.
What about the ISM number and the service number?
Well,
they were contradicting to each other.
All right, well, so here's how this works. So we've got the twin ISMs, the manufacturing and the non-manufacturing, or the service sector.
Right.
The service sector accounts for 88% of the overall economy. The manufacturing sector only accounts for 12%. So we're seeing growth in that 12%. And in many cases, that's responsible for quite a bit of the growth we're seeing, excluding inventories, what we call real final sales. Okay, but in the service sector, we've seen two straight disappointing numbers. In particular, in that leisure and hospitality sector, it actually decelerated significantly down to adding only 12,000 jobs this month. Now, I think some of that's weather related. We're just having some distortions caused by some of the very warm weather we had here in the United States during winter. It's almost like in the Northeast we really didn't have winter.
But is that really the reason for the strong looking winter and not so strong looking spring?
I think that's part of it. Demand was just pulled forward.
Yes.
The weather was so good, a lot of hiring could take place because demand was there, and therefore it's slowing. Now, in that May number, two areas you want to look at: services in general and leisure and hospitality in particular. If we don't see those begin to reaccelerate, then we may have a little bit more of a problem.
Some economists are happy by looking at the past 22 months, and out of the 22 months, in 20 months, we've seen a 39,000 upward revision, they say, in terms of the employment. Are you happy with that? What do you want to see?
Well, I mean, I want to see the numbers revised upward. I want to see better job growth. Moreover, I want to see job growth in high-paying service sector jobs, again, professional and business services, and I want to see the public sector begin hiring again. Two, I want to see that translate into better wages and salaries to support a higher level of spending and allow households to begin to continue retiring debt at an appropriate pace.
Okay, let's talk about the earnings, shall we? Because the first quarter earnings have been beating the estimates. 75% of the S&P 500 companies did so far. How do you read that? Do you like it?
Well, we always like when we beat earnings. However, from my point of view, the bar was set very low. Profit margins are thinning. due to rising commodity cost. So what we should expect to see is a period of mild increases in profit margins, and the analysts will figure out a way to set the bar so low that we have a beat. I don't get too attached as an economist to whether they're beating or not. When I'm looking at the real economy, I'm looking at aggregate demand.
Yes.
And right now, aggregate demand remains historically weak for the United States.
Well put. Thank you so much,
No
Joe, for
problem.
coming to our
Anytime.
studios and sharing all these valuable information with our Turkish audience.